James Gerrish joins us now from Shaw Partners live in Sydney. James, perhaps we'll start with the miners, and particularly Rio Tinto. I mean, some big questions about its social license to operate in Australia, but really, continually pushing ahead with these new discoveries and projects. At the same time, we've got iron ore prices, at those 7.5-year highs.
Yeah, good morning to you guys. Yeah, I mean, another business as usual sort of update from Rio Tinto today in terms of their push into lithium. I appreciate the comments that you're alluding to there in terms of their license to operate. Obviously, a pretty horrific event that's been played out for Rio, and obviously they're dealing with that. From an investment standpoint, I think it does tarnish the reputation of Rio. I don't think that's going to be repaired anytime soon. A couple of senior guys have fallen on their swords as a consequence of that. So, I guess we've got to look at it from an investment standpoint moving forward. You made mention of a really strong iron ore price. And that's what's really driving the stock at this current point in time. So, iron ore up around 150 US a tonne. It's clearly a huge support for Rio as well as the other iron ore miners.
Yeah, James, Fortescue shareholders absolutely happy at the moment. The stock price mooning, as the youngsters would go and say. What to go and take of that price action right now over a longer term period, though? No, would you be still willing to go and buy iron ore miners at the current levels?
Yeah, I'd be reluctant just in the very short term. So I think there's, Fortescue's update today was yesterday I should say, was a positive one. They talked about, strong demand going into 2021, largely on the back of, Chinese demand strong, but also the issues coming out of Brazil in terms of lower production. They did start to talk about the risks of the higher Aussie dollar impacting their input costs. So that's a theme that we should be across in terms of Fortescue. And I think you made mention of Appen just before. I think that was, I haven't seen the details in terms of Appen, but I think that's one of the issues impacting that stock at the moment. They had forecasts for the Aussie dollar around 70 cents. It's obviously a lot above that, and that's caused a major headwind for them. And it's got the potential to do it in the mining space. Obviously, that's being offset by higher prices for commodities at the moment, but I think it's something we should be conscious of.
Hey, James, do you pay attention to uranium companies and the uranium story, particularly on the supply side, that is unfolding right now? Curious to know, what the view or what the conversation is there at Shaw Partners.
Yeah, we look at the uranium space, and I think more broadly the uranium context has been, or the uranium area has been completely underdeveloped for the last 10 years. So, in that context, there's been a lack of new supply coming online because there hasn't been the demand to incentivise that supply coming online. So, prices have started to edge higher. We've started to cover Paladin in the space. So, these are super high risk areas of the market. Paladin, for instance, they need a higher uranium price to get production up and running. But if that happens, then there's massive upside in these stocks. So yeah, it's like an option on uranium buying Paladin at these current levels. So I reckon it's a pretty good risk rewards type high risk play, Nadine.
Well, James, we'll be speaking with Ian Purdy, the CEO of Paladin, a little bit later today. I think it's just after 3, if I'm just going by memory, so you might want to listen in for that one. Otherwise, Link, you can't look past Link. Management there, the board, pretty confident that they'll be able to get a higher offer from one of the two groups that are bidding for the company, correct?
Yeah, correct. And they've obviously, I like the way they're approaching this sort of this offer. They're saying basically that the business is, we're pushing ahead with our business improvement program irrespective of these offers that are on the table. They came out with a trading update yesterday which was sort of ahead of expectations for the half. They also said they're going to push ahead with the demerger of PEXA, which is sort of the area that actually underpinned the better trading experience they've had in the period. So they're pushing ahead as sort of with their transformational plans. There's a couple of bids on the table, the last one at $5.65. The share price is just trading below that. So, I don't own the stock, Nadine. If I did, I'd probably hold on to see how this all plays out. We like two bidders on the table. They're clearly keen to do a deal. That's what I take away from Link in terms of, the price isn't right there, but they'll open them up to the data room and let them have a crack at seeing if they can increase that price. So I like the way they're approaching it. Don't own the stock, hate share registries generally, but if I was there, I'd stay there.
Do you hate McPherson's? Because they came out with a trading update last week, which the market didn't like that, and now their chief executive has fallen on his sword. What's going on there?
Hate's a strong word, Scuddy, so I probably shouldn't use that. Throw that one around. I mean, these guys have had a really tough time in the last. These guys have had a pretty tough time over the last few months. They have obviously raised capital. They've made an acquisition. Now they've had a major trading downgrade, and the CEO Laurie McAllister has now been given the boot. So he has officially resigned, but I think that would have been forced out. His resignation date was yesterday. This is a really tough business. They've got a huge amount of sanitizer still on their books. They don't know what to do with it. Failing the pandemic, God forbid, coming back onto our shores, then I think these guys are going to struggle. And then you've got the risk of a new CEO coming in and rebasing earnings. So not one that I'd like to be in, guys.
Okay, so that is MCP, not on James's Christmas list. James, I'm curious. We have been in the midst of a Santa Claus rally. Potentially a little bit of a pause today, but is that what you're waiting for? I mean, when you look at these markets, do you think that there should be some type of, I'm not going to say correction, but some type of a pullback so that we can then move higher, which most people are anticipating will happen in 2021?
Yeah, it concerns me that everyone thinks that way in 2021. But anyway, that's the way it is. From a seasonal point of view, Nadine, the start of December is generally weak. It hasn't been that way this December to date. I think the index is up around 3%. This time last month, so in November, we had a really strong month. We were up around 6%, I believe, at this point in the month last time. So yeah, I'd be anticipating some short-term weakness in the market. I think we need to consolidate. We've had a huge run up in the market, but the fact that the market hasn't pulled back in any meaningful way, we had a 200-point correction on the end of November before we've resumed this uptrend. So look, I think the market goes higher from here. Whether or not we consolidate or pull back from here, I don't think that's the bigger question from an investor standpoint. I think it's about being positioned for a bullish 2021, and that's what we're all about, Nadine.
James, just to go and finish off, if it came to one risk that keeps you awake at night for valuations and the like, what is it heading into 2021?
Getting Christmas presents wrong, Scuddy. I'm not very good at buying Christmas presents, but going into 2021 in terms of the markets, I think China is a real risk for Australia specifically. I don't think. I think they've showed their hand in the way they're approaching the relationship with Australia, so that would concern me. And then probably the trajectory of interest rates are probably key as well. So if interest rates were to rise a lot quicker than market expectations are in place at the moment, and that could come on the back of inflation ticking a lot higher, that would be a concern as well. But right now, I think we're in a bit of a sweet spot. But again, probably the China factor and rising interest rates too fast might be a concern.
Well, James sleeps like a baby, Gerrish. Thank you so much for joining us from Shaw and Partners. Really appreciate your insights. We'll catch up with you, I think, one more time next week before, we all officially retire to start buying those Christmas presents. See ya.